tendency at times to overplay each set of monthly numbers, given there's a lot of variability around it, and we are in a hugely uncertain and changing climate. Having said that, it is a very important set of numbers, both for the Fed and markets. And I think markets are kind of positioned for a softer number at the moment, and an expectation that we're close to peak rates. The Fed can soon turn a bit more dovish, recession will hit, and so on. So I think if the markets react either way, I think they're more likely to react negatively to a harder number than they are perhaps to celebrate a softer number. And I think there is a risk that, with the expectations being quite optimistic, there's obviously always a risk that the number disappoints, and particularly I think on the core numbers, as you say.
Kevin, to talk about the hard number if it happens today and what the ramifications are, it is the market saying, look, we could get more monetary policy, which slams the brake on the economy. So far, we've had the New York Federal Reserve President John Williams, who says he's not forecasting a US recession, but still sees pretty slow growth. This is the latest in an interview with the FT, and this is a permanent voting member of the FOMC. But these assumptions that the Fed has at this point, that they can skirt around a recession, what view are you holding? Do you think it is inevitable that the central bank does trigger a recession?
I think it is, to a certain extent, and it's partly because we've never been in this situation before of a pandemic followed by a war, followed by an energy and inflation shock. So there's no economic model out there from the Fed down that can really predict what comes next, and the Fed, by their own admission, are being very data dependent. So I think the Fed obviously is sounding very hawkish at the moment. They clearly feel that there's still excess demand in the system. They're concerned about wage growth translating into a longer term cycle of higher wages, higher prices, higher wages, and so on. So they're going to err on the side of being hawkish. But having said that, I think that there is a real risk that they over tighten here. We have to remember that as the economy slows, whether it hits recession or not, and in an inflationary environment, of course, you can have a real recession whilst nominal growth stays very positive. But in this environment, if we have a recession, I think there's still very much a risk that the lagged impact of the tightening they've already done, and we need to remember that this has been the fastest and steepest tightening cycle in a very long time, together with weaker growth, together with the fact that consumers, which is 60-70% of the economy, have already run down their savings significantly, means that there is a risk, definitely, they've already over-tightened. So any further moves to raise rates from here could really make that recession deeper and longer than would otherwise be the case.